ladies and gentlemen. I'm overwhelmed. I'm excited looking at the crowd that has come here. And I'm reminded of the days when your institute started. All of you are aware that the Institute of Chartered Accountants of India was set up an Act of Parliament way back on 1st July 1949. Last message of the day, we have to keep performing for this great country, making it the superpower of the world and empowering our fellow members so that all of us can create history, breach benchmarks. Thank you. Thank you so much.
Firstly, I would like to thank CP Committee Chairman and Vice Chairman Sir of CP Committee for organizing the 86th webinar on a very relevant topic and important topic, namely inward and outward remittance and compliance of factories under the new labor code. I am Sarvan Kumar Agrawal, the moderator of this webinar. We are delighted to welcome you all to this webinar, which is being organized by the Continuing Professional Education Committee of ICAI. Please block your calendar for the CP Committee webinar. It's my pleasure to be a moderator for the 86th webinar on inward and outward remittance and compliance of factories under new labor code from 4 p.m. to 6 p.m. In a short while, we will start this webinar. First, I would like to appraise you about the CP committee. The role of chartered accountant is evolving continuously to accept newer responsibility in a dynamic global environment. The future of CA depends on being flexible and open to innovation. Therefore, the need of the hour is to innovate as per the requisite of the contemporary business environment and accordingly upgrade the curriculums and educate system of chartered accountancy course. The committee also believes that members of ICI should look beyond the traditional area of practical practice and seek and explore new areas of business and profession, and hence the CP committee is mentoring the members by providing guidance through various workshop, seminar, national conference, background materials, and simultaneously by encouraging young and dynamic professionals to grow as speaker, master of ceremony, etc. in the CP program. The program for this evening is as follows. We have two sessions, 1 hour, 1 hour each, and topic are inward and outward remittance, practical case analysis under FEMA and Income Tax Act. A second session is compliance of factory under new labor code. Our eminent speaker will talk about the above mentioned emerging areas of professional interest. Actually, chairman and vice chairman is not have not able to join this seminar. Due to this, I am moving forward to first speaker, Sri Akshat Maheswari ji. Sri Akshat Maheswari ji, he is a chartered accountant with over 10 years of post qualification experience on international taxation and transfer pricing, and specialize in transfer pricing, cross-border structuring, business valuation, assessment and development of organizational SOP, advising leading MNC on inbound and outbound transition. He is a regular speaker and faculty on international taxation, including for ICAI, and has been associated with various professional bodies such as VVSS, IFA, VCAS, and CTC. He has served on a multiple ICAI committee, and he is currently a member of International Tax Committee of ICAI for financial year 2025-26. He is also a certified FAFD professional and has completed the IBBI valuation course and the DIIT course. Now I am now I'm moving to our first speaker, Sri Akshat Maheswari ji. Please start the session, sir.
Thank you. Thank you so much, Shravan sir, for the warm introduction.
Thank you,
I
sir.
thank you to the CP committee for organizing this session. And Shravan sir, if I can just proceed to share the screen, start the session. It's okay?
Yes, sir. Yes, sir. Please start.
Thank you. So just confirm me if you're able to see the screen, sir.
Okay. Not yet, sir.
Yes, sir.
Yes. Yes, yes. Now, yes, sir,
The screen is visible.
it's visible, sir.
Okay, perfect, sir.
Yes, sir.
So thank you, everybody for joining the session. So, and I welcome you all about this 86th webinar on the inward and outward remittances. So, myself, C. Akshat Maheshwar, and the partner of Mrs. Anil K. Maheshwar and Company from Delhi. So, just to set the context of the session, so we have set up the chapters into three segments basically. First would be the FEMA perspective. The other would be the income tax perspective. Then we have done some interplay with the FEMA and Income Tax Act, how to do compliances, reading both the acts, and some practical case studies. So I have around 5-6 case studies at the end, and that I will do at the end. I think technical support, if you can just mute yourself, some disturbances coming from your end. Thank you. Yeah. So firstly, I think everybody whosoever is practicing FEMA was introduced in the year 2000, and it's a replacement to the FERA Act. So FERA is a very how do I say, very basically the FEMA Act is more more persuasive towards promotion and payments of the external trade and foreign exchange market. It's more open act than the FERA Act. And it's a small act which prohibits almost every transaction unless it says that, okay, these are permissible transactions. So that we will be discussing during the course of the presentation. And as you know, unlike the other acts, FEMA deals with a lot of rules, regulations, directions, EP circulars, and the FAQs. So RBI basically give all these regulations and directions to which is available on the RBI portal, which we read time to time so as to comply with the FEMA. And so regarding the inbound and outbound transactions, so there are two types of major transactions which is available with first is the current account transaction, and the other is the capital account transactions. So when FEMA Act triggers basically, so FEMA triggers whenever a resident is doing any transaction in India with another non-resident. I'll just put my laser pointer also. I think laser kaise aata hai isme? I don't know. Yeah, the laser. So whenever resident is dealing with a non-resident in India and dealing with either in INR or foreign currency, then the FEMA Act will be triggered. Or else if a resident is doing transaction in India with a resident as well, but the transaction is happening in foreign currency, in that scenario also FEMA will be applicable. Similarly, if a resident is doing a transaction outside India, irrespective whether that person is a resident or non-resident, FEMA will be triggered. Similarly, whenever a non-resident who is residing outside India, if he or she is doing any transaction in India, but with a resident or a non-resident, either in INR or foreign currency, it will be applicable. Now, there might be a situation whenever a non-resident is doing a transaction with a resident of India, but it is being done abroad. In that scenario, FEMA will not be applicable. Or either way, like, a non-resident is doing a transaction with another non-resident also. In that scenario, also FEMA will not be applicable. So that is a trigger point when FEMA will be applicable to us. Yeah. So just to have a brief, so I've not dealt a lot of sections for FEMA. Only those sections which is concerned with the current topic. We have discussing that only. So first is the restrictions in dealing the foreign exchange. So as I told, FEMA almost prohibits everything unless and until it is specifically specified that okay, these are permissible transactions. So it says that okay, whenever you're doing a transaction in foreign currency, it should be dealt in foreign currency. Who is an authorized person? Only an authorized person can issue you foreign currency or make the transaction happen. Only that person can do. So these days, instead of RBI dealing all the matters, so the RBI has designated the authorized dealer banks for almost all the reputed banks are there, and you have to do the transaction with the AD bank, and AD bank in turn will act as an intermediary between you and the RBI. Okay, and so this is the section 3 which deals with restrictions on dealing in the foreign exchange. Okay. Now, moving on to the nature of transactions, as I told you earlier, section 5 deals with current account transactions. So what is a current account transaction? As per the section, it clearly says that any transaction other than a capital account transaction will be a current account transaction. And the rules governed by this for this current account transactions are as per the current account transaction rules and international compliance. So as a signatory to WTO agreement also, it's a general statement I've mentioned. India generally does not impose any restrictions on payments and transfer of international line without the approval of IMF. So that's a general statement. It's not required as of now. So in the current account transaction, there are 3 schedules which we need to consider. Schedule 1 is the prohibited transactions, that is strictly not allowed. Person being a resident cannot do these transactions by they can't even seek for approval from the RBI or the central government. Schedule 2 deals with government approval, which requires a prior approval from the government of India, from the central government. Only then you can do the transaction. These transactions are primarily related to investments in certain companies and all. So that we will discuss what all transactions governed under Schedule 2. And Schedule 3 is RBI approval, that okay, you have to go to the RBI, ask for the approval, and only then you can do the transactions. So as I told, RBI has designated AD bank. So instead of applying directly to the RBI, you need to approach the AD bank, and AD bank in turn will take your case with the RBI. And so the prohibition on so in case of Schedule 1 transaction, I told it is strictly prohibited. And the other transaction is in case of traveling to Nepal and Bhutan, the drawal of foreign currency is prohibited for travel to or within Nepal and Bhutan. So you cannot, exchange the foreign exchange for Nepal and Bhutan. As you know, in those countries, Indian rupee can also work. So what you can do is you can go to Nepal or Bhutan and get the currency exchange. There it can be done, but not in India. And similarly, you can't do transaction with the person resident in these countries through in foreign currency. Now, the other transaction leg is the capital account transactions. So capital account transaction is defined as a transaction which alters the assets and liabilities, including contingent liabilities outside India of a person resident in India first, and which alters assets and liabilities in India of a person resident outside India. So the person India ka hai, uska bahar koi asset is getting altered, or vice versa, a non-resident is having its assets or liabilities altered in India. So that will be capital account transactions. So certain regulated transactions are, I'll just share in the screen as well. So following transactions are prohibited, restricted, or regulated by the RBI. So you have to seek for RBI approval in that scenario. So in case of transfer or issue of security by a person resident in India, you have to approach AD bank and ask for the approval. Only then you can do the transaction. Similarly, issue of security, transfer of security, foreign security by any branch, any agency in India, President of outside India. In that scenario, also you need to approve the RBI. The RBI, I mean by 8 to AD Bank. So AD Bank is authorized dealer. I think I've not intimated that before. Okay. And similarly, all those transactions are list of capital account transactions which are there. And I think in order to save the time, we have to move forward. So now firstly we're talking about outward remittance. So outward remittance means any drawal of foreign exchange from authorized person, that's a foreign transaction. Any opening of LCs, that is also that is also transaction for which remittance is to be done outside India. Any use of international credit card or debit card, or either by whatever name called for for making payment abroad, that is also called as outward remittance. And by whatever transaction it is called has the effect of creating foreign exchange liability, that is an outward transaction. Okay. So if you have any doubts during any course of the point or any course of the slide, just mention the slide number, and at the end of the session I can come back to that slide and then we can discuss in detail. So current account transactions, so first is Schedule 1, which is the prohibited transactions. So you cannot remit lottery winnings if you're doing any lottery winnings in India. That is not permissible. Similarly, racing, all the winnings from race, that is also not repatriable. Purchase lottery tickets, payment of commission on exports, on towards equity investment joint venture, that is also not repatriable. Dividend on which different balances is applicable, that is not applicable. Rupee state callback, subsidy telephones, interest income and non-resident special rupee scheme account, that is not repatriable. So that's a exclusive list. Only these transactions are prohibited transaction. Similarly, for Schedule 2, for this you need to approve. You need to have the prior approval of the central government before making any making the transaction. First is the cultural tools, advertising foreign print media exceeding $10,000. Trade vessel chartered by a PSU. In that scenario, also you need to get the central government approval. Import through government department, multimodal transport operators. So as you know, there are a lot of multimodal transport operators who are acting as an agent. For example, the shipping companies, road liners, all those transport operators has to seek for prior approval of central government before indulging in these transactions. Remittance of hiring charges by transponders, by TV channels, internet service providers. These are two by the same line. I think they've coming next row. And remittance of container detention charges and prize monies exceeding $10,000, be it Olympics, be it anything exceeding 1 lakh dollars. If that is the scenario, then you have to seek for central government approval. Next is the Schedule 3, transaction which requires approval of RBI. The first and foremost is the USD 250,000 limit. So the USD 250,000 US dollars limit is available to all the resident individuals. These persons can avail foreign exchange facility for certain transactions, which is permissible transactions, and you don't have to seek RBI approval, and you can make the transaction. And this limit is applicable for a financial year, not Jan to December, but the financial year, i.e. April to March. And this cannot be clubbed with anybody, and this is a limit for every individual. Next, private visit to any country, then that's also you need to take approval from the RBI. Gift or donation, going abroad for employment, immigration, maintenance of close relatives abroad, travel for business, attending a conference. In that scenario, you need to seek RBI approval. Studies abroad, medical treatment, all those scenarios, you need to take the RBI approval. Okay, I discussed the LRS limit to $50 in the financial year. Okay. So this is a small chart I've prepared that, okay, what was the LRS limit initially? Earlier it was $25,000 US dollars, it increased 50,000, and depending upon balance of payments, RBI always increases or decreases the limit. So presently, I think since 2015, the limit is still the same, $250,000 US dollars, and that has not been changed. till now. And as I told, the scheme is not available to corporates, partnership firm, HF trust. Only individuals are allowed to take the benefit of this LRS scheme. Okay. So what are the permissible capital account transaction by an individual under the LRS scheme? So current account transactions we have discussed. Now we're just discussing about what is the permissible capital account transactions. As I mentioned in the earlier slides, which alters the assets and liabilities of a resident outside India or of a non-resident in India. So first is foremost is opening a foreign currency account abroad with a bank. Yes, in that you can do LRS. You can take the avail the benefit of LRS. Any immovable property which you can you want to buy, that you can buy. A non-resident can buy property in India. What property, that we will discuss in subsequent slides. And any extending of any loan, Indian rupee to NRIs, again, the compliance of other acts as required will be applicable. In case of Companies Act, the related party schedule and all those things, compliance is to be done. So okay, and very important is that the scheme is not available for remittances for any purpose specifically prohibited under Schedule 1 and Schedule 2. In this scenario, it is not permissible. Again, so and also the scheme is not available for capital account remittances to countries identified by Financial Acts Task Force. These are companies as non-cooperative countries or the terrorist activities countries. List is available at the Government of India portal, and they also say so. Whenever you are making a payment to those countries, you will never get the approval. So in past also similar at matter came to us as well, wherein we were supposed to make the payment to a such country which is classified as a FATF. So it was not permissible, and we have not done that transaction. So ultimately, entire rearrangement was done by setting up an entity somewhere else and taking the transaction through that. So that is a separate aspect altogether. And TK, under LRS, you need to provide your PAN number. That is a mandatory document for taking the benefit of NRS. So earlier what we have discussed was related to outward remittances. Okay. Now what can be the inward remittances that we have discussed, that we're discussing? So inward remittance, first and foremost would be a non-resident. Suppose he wants to invest in India, how will he be investing? For example, he can seek for ECBs. He can open a licensed branch office, project office in India. He can do FDI in India by so again in the next slide I'll tell you what can be the FDI areas. And other than FDI is also portfolio investment, joint ventures, purchase of property. All those cases you can that person can be termed as inward remittance. So inward remittance ka ek aur naam we can say inbound investment, and these are as per the non-debt rules of 2019, which is recently been implemented. And so as I told, routes for investment are FDI, foreign investments, portfolio investments, venture capital investments, purchase security by other non-resident investors, investments AIF, REITs, InvITs, and investments on non-repatriable basis. Okay. So first is, okay, FDI can be done through a company through automatic route and approval route. I have not discussed what is automatic route and approval route. So there are sectoral limits. In certain sectors, for example, defense sector, there's a sectoral limit that, okay, a foreign company can only invest up to 26%, for example. So if suppose that person is investing more than that, then you have to go for the approval route. Otherwise, it will be automatic route. Mostly transactions are covered under automatic route until unless very sensitive areas are there. And so okay, and one point is investment non-repatriable basis. So certain if a non-resident doing a certain transaction in India, it can be either on non-repatriable basis or repatriable basis. So by non-repatriable basis, it clearly means that, okay, whenever you're doing an investment in India, you cannot repatriate the funds back to India. It has to be there in India itself. So you can't repatriate. So there are certain companies or which are controlled by NRIs, but that person cannot take the funds outside India. And certain investments are on repatriable basis. For example, any person who is investing in India as a property, you can sell the property and repatriate the funds back to your home country. Okay, this is the example. What are they on repatriation and non-repatriable basis? So government securities, debt, listed national pension scheme, all those are under repatriable basis. And non-repatriable is, chit fund companies, listed debentures, national plan saving certificates. All these are on non-repatriable basis. Okay. So whenever an inward remittance are being coming in India, so we have to have certain key pointers in mind that investment should fall under the sectoral FDI limits. That it's very important. Otherwise, it will be deemed as a non-compliance, and lot of other acts are also there, which we will discuss also, that they can indulge in those acts. For example, the Black Money Act, ED can question you as well. So it's very critical to follow all those limits. Inward remittance should always be through a normal banking channel, and the RBI needs to be reported within 30 days in the receipt of the FDI. So by RBI we mean the AD bank, because RBI has delegated its power to the AD bank. And NRI OC can acquire by way of purchase any immovable property other than agricultural land, plantation property of farmers in India. This is very important. A non-resident cannot invest in a farmhouse or parcel of land or agricultural land. And the non-resident spouse of the NRI may acquire one immovable property other than agricultural land jointly with her or his NRI OCS spouse. Okay. So this was the basic idea of the FEMA Act. So again, since I have only just 1 hour in my discussion, so we'll just discussing the important sections which is required for this presentation. Now, whenever we are doing an outward remittance, so Section 195 of the Income Tax Act comes into play. So Section 195 says any person responsible for making payment to a non-resident shall withhold tax. So by any person, that person can be a resident or that person can be a non-resident as well. But if it is required to withhold tax, that person, he or she has to deduct tax in respect of other sum chargeable under the Income Tax Act at the time of credit or payment, whichever is earlier, at the rates in force. So I have not discussed who is a non-resident from the FEMA perspective, who is a resident from the perspective of income tax. The definition of both the residents is different. So that is not we are discussing today, because that's a separate area, which is talking about inward and outward remittances. Okay. So Section 195 deals with. So now, after reading 195, we have also to read 195(6), which has been inserted by Financial 2008. That whenever you're making a payment to a non-resident, you have to make certain compliance and follow Rule 37BB of the income tax rules, which requires that Form 15CACB is also required to be submitted to the income tax department for making an outward remittance. Okay, now this is so Form 15CB is the requirement of the chartered accountant to submit to the company, and 15CA will be tagged to that 15CB, and jointly it will be submitted to the AD bank for processing the payment. Now, along with 15CACB, there's also a return, Form 15CC return, that needs to be filed by the AD bank, declaring what all remittances this person has done during the entire quarter, and they also tag it with the 15CA reference number. And if there is a mismatch, the department will give you probably a show cause notice that why there's a difference. And nowadays, lot of notices are coming in respect to this aspect as well. So a small slide about 15CCB, that whenever the payment is made to a non-resident, if no, then 15CCB is not required. If yes, we have to check whether Rule 37BB that transaction is covered. If yes, then 15CCB is not required. If it is not covered, then we have to follow whether the payment is taxable in India. If it is not taxable, then we have to file Form 15CA Part D. Now, if it is taxable, whether the payment is less than 5 lakh rupees, and if it is less than 5 lakh rupees, then we have to file Form 15CA Part A. Okay, if it is more than 5 lakhs, but we have taken the order under Section 197, 195 to 195(3), it's again a mistake, 195(3). So we need to file 15CB CA and Part B, and And if it is not falling under 127 this, so we have to submit 15 CB in part and file form 15 CA part C. So again, it's just a columnar form of whatever we have discussed in the earlier slide. We can move on to forward. Okay. So now, whenever you are making output, you are giving a certificate regarding output remittances. Always seek all these copies from the payer that okay whether the transaction is legitimate or not. Because see, if any false transaction happens, income tax department will also give this this view to the FEMA, and once FEMA get triggered, so there are a lot of enforcement directed people, the Black Money Act people, they can make a little critical about all these information. And okay, and I think next we want to move on. Again, this is Form 10F. So now Form 10F has been done, has to be filed online. Okay. Document which is required, Form 15 CACB. Okay. This we can, I think, move on. Okay, so that is the process. Remitter will obtain Form 15 CB, upload electronically the details, and Form 15 CB mention 15 CB acknowledgement number. Then both will be downloaded, digitally sent to the AD bank. AD bank will remit to the RBI, and the 15 and the copy of undertaking forward to AO by the AD, and all this, and then everything is interlinked. Okay, so that was about section 195 regarding outward remittances, for which we have to do the compliance under section 15 CCB. So there's also another act now, the TCS, the tax collection at source. So now whenever we are making certain payments in regards to transactions abroad or any payments abroad, in that scenario now the government says you have to collect a tax at source as well. So that's an additional burden for which you have to collect tax and deposit to the government, and later on you can claim the credit. So as per the provisions of section 206C, TCS is an additional amount that collected on specified rates on specified goods, on supply of specified services, and similarly buyer of specified goods and recipient of specified services. The point of collection is same as it is there in the TDS, which is earlier of the following of receipt of amount from collectee or posting in the books of accounts, whichever is earlier. Okay, so now there is one section pertain to, so again I'm not discussing all the sections of TCS, only the specific sections, which is 206C1G, and we are discussing. And so I have mentioned two slides, the old and the new slide. So recently, now that the value has been changed and the rate has also been changed. So in these two slides, there is no change in point in column number 1, 2, and 3. Okay. So I'll just explain what is the table about. So 206C1G deals with any remittance on account of LRS of the RBI. In that scenario, TCS will be applicable. There is a certain list of transactions under which this TCS will be applicable, which we'll be discussing. And the other is sale of overseas tour package program. On that as well, TCS will be applicable. So for transaction number 1, the AD bank who has received the amount of remittance under LRS, RBI outside India, collector. For transaction number 2, collector is the seller of the overseas tour package, which is the travel agents. Collectee is the buyer who remits the amount from the AD for remittance. And for transaction number 2, buyer of the overseas tour package, which is generally our case because we are availing the tour facilities. So now the rate of TCS, in case of earlier, what was the rate was? 5% if the value exceeds 7 lakh rupees. Okay. And okay, and 5% for transaction number 2. There is no threshold limit for transaction number 2. Okay. And in case of any medical reimbursement, I think this point is pending, the medical point. In case of medical, the rate, same rate, sorry, okay. And 0.5% is case of remittance on account of education if the value exceeds 7 lakh rupees. So I have certain case studies also, which we'll be discussing on what rate the TCS will be applicable. And this is on account of amount being remitted out as loan obtained from any financial institution as defined in section 80E. So if you're taking a loan from a banking financial institution as per 80E, in that scenario, the tax rate would be 0.5%. Okay. Now, what is the scenario today's date? Now it says that any amount of remittance under LRSM, if it is exceeding 10 lakh rupees for transaction number 1, 20% TCS will be collected in that scenario. And similarly for the overseas tour as well, if it is exceeding 10 lakh rupees, 20% TCS needs to be collected and 5% TCS to be collected in case remittance is on account of medical treatment or education or transaction value exceeds 10 lakh rupees. Now, if the transaction for education is through any financial institution, there is a change that there will be no liability to collect tax in that scenario. So that's a big relief because earlier what we used to do, we used to collect 0.5%. That was an additional burden upon the collecting. Okay. And again, the government, these are certain clarifications, the FAQs released by the RBI and for current account transaction rules. And they have given an exemption that, okay, if you're using any international card for meeting expenses by a person in abroad, means the credit card is swiped in abroad itself. In that scenario, TCS will not be applicable because the remittance is not being done from India to outside India. Okay. And similarly, for every drawal of foreign exchange for transaction, including Schedule 3, prior approval RBI shall be governed. This we already discussed. And the limit is $250,000 for the entire financial year. So apart from this, I think there is no in compared to Income Tax Act. Only these are the issues which are there in regards to inbound and outbound investment. Again, this we have discussed in one very broad level due to time constraint. And the other issue which I was discussing with in previously was we have to also consider the Prevention of Money Laundering Act, Benami Transaction Act, Income Tax Act. With this we have done withholding tax DTAA, TP, ITR, Section 56 GAR, General Anti-Evasion Rules, and the Foreign Contribution Regulation FCRA, which is there in case of charitable institutions. Because whenever any international transaction has happened now, so it can trigger all these activities as well. Okay. So these were the basic understanding about the acts under FEMA and Income Tax Act. Now we move on to case studies, which is the very important factor of this entire presentation. So first, after pain reading, so I have certain we have discussing certain examples, general life examples, which are there. So first is, for example, Mr. X, he wants to do following. Mr. X is a non-resident. Non-resident, what is pending here? Mr. X is a non-resident. He wants to make investment in different types of immovable properties in India. Okay. First example. Second, he also sell 3 house properties and remit the sales proceeds abroad. Sell 3 plots of land and invest in new agricultural plot of land. Lease out 10 flats and earn rental income. Okay. So first question which arises, in our mind is, can NRI invest in which type of properties? Okay. Will a leasing of multiple properties possible? Okay. What will be the tax on rental income for NRIs? And if any sale of properties and earning of capital gains, any capital gains arise, how will the withholding tax be done and how the funds will be repatriated? That will be discussing. And repatriability of gains and rental incomes. Okay, done. So after pain reading, so again, I have certain next in the next scenarios we have mentioned all the points as well. So as we have discussed earlier, NRIs and OCs are permitted to acquire IP in India. IP stands for immovable property. NRI and OCs can acquire any immovable property in India except agricultural property, farmhouse, plantation property. That's also we have discussed. So that is clear. We cannot do that. Now, the next question is, he wants to sell 3 properties and remit the sales proceeds abroad. Okay. Yes, he can. In point number 4. In that scenario, yes, he can sell the 3 properties. The buyer will deduct tax on account of his gain, and that entire sum after payment of tax can be freely repatriable. Again, the TDS will be done under section 195 and not 194 IA, because 194 IA is only in case of residents. And if the tax rate is high, then that non-resident or the resident or the buyer can directly go to the income tax authorities and seek for lower withholding tax approval. So in 195(2), the buyer will go, the seller will go. In 195(3), the buyer can go, and in 197, either one can go. I think this we have discussed in this already know. And okay, so one question is that in case of rental income, any person, there is no limit as such how many properties you have rented out, and if you have, after paying the taxes in India, you can repatriate the entire amount. That is permissible. But what is not permissible is that you involved in activities of trading. That point is not mentioned there. So a non-resident cannot trade in selling of property in India or abroad, either way. So that is not permissible. Okay. So this was related to point number, the case study number 1. Okay. Next, we move on to case study number 2. Case study 2 is also regarding Mr. X, a non-resident, wants to make a portfolio investment in Indian securities. Okay. So it means he wants to buy a stake in any of the companies, and he wishes to have the flexibility of remitting the surpluses abroad. What will be the FEMA provisions for the same? What are the tax implications of capital gains earned out of sale of these securities? And what are the implications for dividends earned on shares? Okay. So as we have discussed again in the previous slides, a non-resident can invest in Indian securities, that it can be done. Okay. Now, the capital gains to be done without adjustment with unexhausted basic exemption. So the non-resident will not be allowed to have the basic exemption limit as well in this scenario in case of capital gains. And chapter 60 mein koi deductions bhi he cannot claim. Taxability of dividends, as we discussed, 20% flat rate with the long term, which has been changed to 12.5%. Okay. And the short term will be as per the आपका वो 111A, which is 15%. And okay, and a non-resident can also avail the benefit of TT by providing from the TRC in Form 10F, and whichever is more beneficial, that non-resident on that in case of that non-resident, that amount will be deducted. And dividends are freely repatriable without any limit. If investment made on repatriation basis, no limit on remittance. Otherwise, the remittance can be under $1 million scheme. So there is a $1 million scheme which we have not discussed earlier. So these are available to non-resident who are making investment in India, that they have a yearly limit of $1 million. Only you can transmit that much amount to abroad. Otherwise, you have to seek for RBI approval as well. And before repatriation, the tax need to be paid in India, and the chartered accountant who is giving the certificate, that 15 CBs will be mentioned that okay, tax has been withheld and due tax has been paid in India. Only then the remittance can happen. Okay. Okay. Next is if Indian person is purchasing a property from a non-resident. So now, in this scenario, Mr. A is from New Delhi and he's purchasing property of more than 1 crore from Mr. Patel or a taxation of USA. And as we discussed in the case study number 1, section 194 194A applies only for resident seller. And in this scenario, section 195 will be applicable. And the person has to obtain TAN as well. So, and the buyer has to obtain TAN, and the buyer has to file the TDS statement under section 227Q as well, the TDS return. And only then the credit will be given to the seller. And Mr. A will issue Form 16A to the seller. And that person, when filing the return of income in India, can claim the tax credit, and due tax can be paid along with the due capital gain tax amount can be paid. And so Mr. Patel can also make an application. Okay. And for making the outward remittance, Mr. A need to file Form 15C and obtain Form 15CB. Yes, that we have also understood. So this is one summary regarding FEMA Act. Let's suppose in this transaction, buying agricultural land, farmhouse is prohibited to NRIs. Buying other animal property is permitted. Business investment permitted via non-repatriable with sectoral restriction that is there. Now, loan by NRI OCI to resident companies permitted in terms of Schedule 7 of the FEMA regulations. Loan by NRI OCA to resident individual, it's not possible. That is clearly defined under Schedule 1. Loan from resident to NRI PIU relative. Loan from resident to NRI PIU. So, it's an outward remittance basically. Allowed in NRO account subject to terms and conditions. Okay. Gift of funds from resident to non-resident. A resident is given to non-resident. Again, we have to check the LRS limits that we already discussed in Schedule 3. And gift of funds from resident to non-resident abroad. Again, this can be done again from, as per the LRS and TCS limit, as the case maybe will be applicable in this case. Okay. Next case studies on aspect of TCS. So certain, for example, we have this case study 4A, 4B, and 4C. The three cases are almost similar, but the answers can be all the answers can be different. So Miss A has to remit her fees of 20 lakh rupees for pursuing her undergraduate degree in USA. How will TCS be attracted in the following cases? So let's suppose her father has transferred the funds from his account to his daughter's university directly. Okay. So since this is for a university, this is education related work, the amount which has been transferred directly to the university, TCS will be applicable. And as we discussed in section 206C1G, so in this case, whether TCS will be applicable or TCS will not be applicable. So in this case, TCS will be applicable to the tune of 5%, as we've discussed, because it's for education purposes. And had it been a case wherein the person has obtained the loan from the financial institution, in that scenario there will be null TCS. But that's a change which has been recently done. And similarly, her friend located in Mumbai has transferred the funds from his account to the university directly. Okay, since the friend has transferred to the university, it is not will be termed as a relative. And in that scenario, the TCS would be 20% in this scenario. Similarly, her friend located in USA. Now, okay, this is in case of Mumbai. Now, the third question is, her friend is located in USA, has transferred the funds directly from her account to the university. Now, this transaction, whether TCS will be applicable? TCS will not be applicable. Why? Because the transaction has been happened from directly from abroad. Okay, so in this scenario, TCS will not be applicable. Fourth point is, Miss A has been rewarded a grant loan from private trust for funding her education. The trust has transferred the fund directly to the university directly. In this scenario, again, the funds have been transferred from the trust itself. So within this case, it will be applicable. According to me, it will not be applicable because it's not a LRS. It is not a LRS transaction, because LRS transaction is applicable only in case of individuals. The trust is not an individual. So in this scenario also, TCS will not be applicable. Now, on this context, certain changes in the equations. In point number 1, her father has transferred the funds from his account to Miss A, and she has paid the university while she is in Delhi. Okay, now whenever that either Miss A pays or her father pays, TCS will be applicable because you're remitting in the funds from, if it is more than 10 lakh rupees, then TCS will be applicable. So yes, 5% TCS will be applicable. And her friend located in Mumbai has transferred the funds from his account to Miss A, and she has paid the university while she is in Delhi. Again, in this scenario also TCS will be applicable. Her friend located in US has transferred the funds from her account to Miss A, and she has paid the university while she is in Delhi. Irrespective, the payment has been done from USA, TCS will not be applicable. And similarly, trust wala matter we already discussed. One point comes in, Miss A has to remit her fees of 20 lakh rupees for pursuing undergraduate degree course, and she has used a life saving which has been offered for tax and return. So a lot of people, are seeing these cases to discussing with us as well, that it's already tax paid funds. But again, the department says nothing doing. Has this been a tax paid fund as well? If you're falling under the category of 206C1G, then you have to pay the TCS and you can claim the credit. So I understand this is a working capital blockage that we need to take care. Okay. Next case study. Again, the last case study, I've merged all these three case studies into one single slide. for example, Mr. X has to travel to Germany for his medical treatment. He is estimating an expense of 10 lakh rupees to be remitted. Does he have an option of availing benefit of lower tax collection? So again, 197 deals with lower withholding tax, not lower collection of tax. So in this scenario, there is no relief as such. If the amount is crossing 10 lakh rupees for being a medical purpose, TCS of 5% needs to be deposited and you can claim the credit as well. Similarly, now a question is, Mr. X has taken a loan against property for his son's educational course in Paris. He wants to know whether his loan is covered under Section 80E of the Income Tax Act, so that concessional rate of 0.5% is applicable. 0.5, now the rate is nil actually. Now, thing is, the 80, whenever you're taking a loan under Section 80, the bank directly transfers the funds to the university. Only that happens. Now, this is the case wherein you have taken loans against property. Now, according to me, the funds will be transferred by the individual directly by the individual to the education institution. In that scenario, TCS will be applicable. Again, if you have any points for discussion, that we can discuss after the presentation. But according to me, TCS will be applicable. Okay. Now, one transaction regarding the credit cards. So, as you know, now whenever you are making any purchase through a credit card from overseas, there's a additional, if the amount is exceeding 10 lakh rupees, there's an additional charge also that's been debited in the account statement that okay, you're required to pay 20%, and you have to pay that 20%, and that the company will be depositing on your behalf, and that you can claim as a credit. So the limit again is 10 lakh rupees. And there's one practical scenario I've faced, I got to face is that okay, Mr. X has made an international transaction through credit card which exceeds 10 lakh rupees. At the month end of the credit card company duly deposit the TCS on behalf of Mr. X. But at a later stage at the time to clearing cycle, Mr. X defaulted in making the payment to credit card company. Now, what will be the impact? Now, see, that credit card company has already has collected the TC, has shown the TCS amount, and but that person is defaulted. So ultimately, he can avail the benefit of the tax credit as well. So that's again a practical scenario which is coming in this all these transactions. Yeah. Okay. And yeah. So this was my main presentation about all the inbound and outbound transactions in respect of FEMA and the Income Tax Act. Again, due to time constraint, I've highlighted only major points, which will give you a little curiosity that okay, how to look on both the acts. And if you have any questions, you can always call to me and mail me as well. And CP committee has also the my details as well. And now, Shravan sir, just if you have
Yes,
any
sir.
questions, we can take an open house and discuss
Yes, sir.
that.
Yes.
Yeah.
I'm just opening, sir, question answer.
Yeah.
Mr. Mehta, you hear me, sir? Hello? कैसे आ गया? कैसे हुआ?
जी प्लीज
आवाज आ रही है सर आपको? You able to hear my voice, sir?
It's audible, sir. You can put forward the questions.
Sir, Mr. Mehta has asked what will be the FEMA implication for transfer of fund through banking channel by resident father to his resident son, and vice versa. What will it will require approval? Yeah, it is exempt with a limit, etc.
So see, as we told that okay, whatever funds you are transferring to your son, again we need to check the volume. What is the amount being transferred? If it is under the LRS limit, so under the LRS limit, you can transfer up to $250,000 in a financial year that you can transfer. Now coming to the angle of TCS. Now, even if you are transferring the funds to your son, if it is more than 10 lakh rupees, then in that scenario, 20% TCS needs to be deposited to the government that you can claim as a credit. that's a working capital blockage, not blockage, I'll say, yeah, working capital blockage that will be coming to you, but that you can claim as a credit while filing the return of income. Yeah.
Okay. Okay, sir. Mr. Mehta has asked also another question.
Yes.
Does opening an account with PayPal get government govern here?
Okay, so yes, PayPal is now again. So PayPal, how do the PayPal accept? Again, so PayPal is a not a good example because we have been dealing with a lot of because it is PayPal. Whenever you do the transaction through PayPal, it is not routed through proper banking channels. So as per the income tax authorities, they are also scrutinizing a lot of things that okay, whatever the funds are being credited to PayPal account, whether TCS compliance has been handled or not. So yes, now if you're loading the money, let's suppose up to more than 10 lakh rupees, then that PayPal will automatically tell you that okay, you have to collect the TCS of 20% as well. That will an extra burden you have to upload on the portal. Only then you can make a remittance. So I have not tried PayPal as of now, but when I earlier used to do it, they were asking. Now I've stopped using PayPal as well because it's a very gray area now using PayPal.
Okay.
Yeah.
So Mr. Mehta also asked another. Actually, Mr. Mehta has asked 5 questions actually.
Okay.
The third one is from Mumbai. With many professionals seeking freelancing option through online website, does payment deduction of intermediary fees by these freelancing intermediaries website get governed under FEMA, and what are the implication of such payment withholding?
Okay, so see, so I'll tell you, basically, you have to check the angle of, so under FEMA, firstly, yes, if you're doing any transaction with a non-resident, then yes, you have to, and if it's a permissible transaction, you can do it, right? So I am assuming that, let's supposedly, you are for getting the work, you are giving a certain commission for getting that work to that non-resident. For example, let's take that example. Now, under FEMA, okay, you can do that transaction, it's a permissible transaction. Now, coming on to the Income Tax Act, we have to check whether that commission income which you are paying is subject to tax in India. If that income is subject to tax in India, then yes, you have to withhold the tax as well while making the remittance. Now, as you see, now I think when we also do a lot of payment through credit card as well for getting services from abroad. When taking the credit card, they deduct the entire amount. So let's suppose $100. But if that income is subject to tax in India, you have to gross up that amount and deposit the tax to the government. Otherwise, if you can seek from the approval from your vendor, you can deduct the tax amount and remit the balance amount. So both the acts have to be separately dealt with.
Okay. Mr. Mehta has of Mumbai so he wants to slide 25. What was the last option? Slide number 25.
Slide 25.
What was the last option?
Is this visible screen visible, sir?
Yes. Visible. Yes, sir.
So 25 is, so again, if I come to, let's supposedly any person who is the buyer, who has availed any order under section 197 or 195 to which deals with lower withholding of tax. In that scenario, you need to file Form 15CB Part B. So first is Part A. Part A we discussed when the limit is less than 5 lakh rupees. Part D is when it is not taxable, which is mentioned here. 15CB, 15CA Part D, and Part C is there. In case of all the other cases, it is Part C. And Part D is in case Part B is in scenario where you have taken the lower withholding certificate. If you have any question regarding this slide, now, so you can mail me as well. I can, we can discuss in detail as well. Yeah.
Mr. C.A. Rahul of Vrindavan asked gift from NRI to resident Indian. Is it possible? Gift
NRI
from
to
NRI to resident Indian.
Again, we discussed now whether NRI to resident, we have to check on which banking channels. Is it a family who has transferred, so that resident is getting the funds out of certain will or certain thing? We have to check the base transaction. Okay, merely remitting the fund, gifting the funds is not permissible. But had it been certain, he's a family member there and he has set up a will. in that scenario, you can take the gift on that account. But otherwise, it's a prohibited transaction.
Kiran Basant Bochwal, Baroda, asking question: Form 10F to be
Yeah.
taken compulsory even when TRC and PE declarations taken.
Okay.
Question also a second, if service availed from foreign law firm P 10 lakhs having no CP in India, which part in Form 15 CA applicable D or C?
Okay. So first, the first leg of the transaction, Form 10F. So Form 10F is required if the TRC is not fulfilling the Rule 21AB guidelines, specific requirements. So in TRC, if these are parameters, if all this information is available in the TRC, then Form 10F is not required. But when we have checked most of the TRCs now, all these parameters are not there. So we have to take Form 10F. Now I think the question would be, if suppose the TRC is having all these details, then whether TR 10F to be filed or not, you can file, but it will be litigative. It's not required because if it fulfills the criteria, 10F is not required. And now Form 10F has to be filed online, be it a non-resident having PAN in India or no. Either way, you have to file Form 10F. Now the second leg of the question we were asking was that in case of which type of payment was it, sir?
When TRC PA declaration taken, and second, if
Law firm,
service
law
paid
firm,
from
law firm.
foreign law firm,
Yeah, foreign law firm. Now, foreign
fees
law
10
firm,
lakhs.
yeah, now as per the if you read section 195, read with section 9, you will check that, okay, whenever you're making to a non-resident, it will be deemed as a professional technical services. As per Indian Income Tax Act, tax withholding is required. So you need to withhold tax under section 115A of the Income Tax Act, which is around 20%. Now, let's suppose that law firm is a tax resident of USA. In USA, you have to check that, okay, in case of fee for professional services, there's a make available clause. You need to understand the treaty as well. In the treaty, I think you can avail the benefit of treaty and there will be nil withholding tax. If there's a nil withholding tax, but under the domestic law it is taxable, in that scenario, 15CA Part C will be applicable because you're not deducting tax, I understand, based on treaty taking the treaty benefits, but it is still taxable. So in that scenario, even though tax has not been deducted, but it is subject to tax in India, Form 15CA Part C will be applicable, not Part D.
Okay.
Yes, sir.
CA Deepa Ashok Bhatt from Mumbai.
Mhm.
Can any resident give regular transfer gift to sibling and parents in India, and whether from her NRO account or foreign account?
Okay, so the NRO to NRO is not permissible in that because it's an Indian account as well. So in NRE, suppose any inward remittance has been done to your relative, that can be permissible from NRE to
NRO or foreign
this
account?
normal saving account.
NRO account can give fund to parents in India from NRO or foreign account.
They can give, they
From
can, yeah.
three account.
They can gift in the Indian account, in the Indian saving bank account. But what will happen is your Indian bank account the bank will ask for a FEMA declaration. What is the source of fund and what is the purpose? They have to mention the purpose that it is for family maintenance or like that. In that scenario, you can do it.
Okay.
Yeah.
Mr. Mehta, sliding to does capital account transition get covered under any other sum? Say there is remittance towards purchase of intangible assets. Will TDS to be attracted and Form 15 CACB need to be filed?
So you are saying that, okay, if an Indian company,
Yes.
Indian person is buying an intangible property in abroad, right? In that scenario, while making the payment, it is going to be deducted or not, right? I think that is
Yes, yes.
right. So then
Yes, right.
we have to check section 195. 195, we have to read section 9, which is section 916. I think 916 will be triggered here in case of royalty. 916 may, if that intangible asset is falling under the category of cooperated article, then yes, TDS under Income Tax Act will be applicable. After reading Income Tax Act, please read the respective DTAA. DTAA may you can avail the benefit of the certain make available clause or certain be it most favored nation clause if any option is available. Under Income Tax Act, it will be taxable. Yes, sir.
So question answer is over, sir.
Okay.
Thank you, sir. Thank you, CA Action Message, for sharing your valuable knowledge on the very good topic. It will helpful to us a lot.
Thank you,
Thank
sir.
you, sir. Thank you. Thank you,
Thanks,
sir.
sir. Thank you so much. Thank you. Thank you. Thank you, everybody. Thank you.
Thank you. Moving forward to our second speaker, Mr. Chetan Agarwal ji.
Yes, sir.
Audible is on.
Yeah.
Yeah. Moving forward to our second speaker, Chetan Agarwal ji. Mr. Chetan Agarwal ji, he is a qualified chartered accountant and member of ICI with graduation and post-graduation from Rajasthan University, and has 4 years of specialized experience as a labor law consultant. He has strong expertise in Indian labor legislation, including the Industrial Dispute Act, Shop Establishment Act, Factories Act, Contract Labor Act, and New Labor Code and Social Security law, and has played a key role in the labor law audit for major corporate and non-corporate clients. He advised organization on labor law compliance, HR policy drafting, statutory register returns, represent employer during labor inspection and proceeding, ensuring practical and risk mitigated compliance solutions. He is also actively involved in training students and professionals on labor law and payroll compliance, with a focus on simplifying complex legal provision and their real world application. Moving forward to our second session speaker, Sri Chetan Agarwal ji. Thank you, sir. Thank you. Thank you for joining. Please start your session, sir. Yes, sir.
Thank you, sir. Thank you,
Yes.
Soranji.
Thank you.
And once again, thank you, CP committee, Satish, Vishnu sir, and other members, and of course, audience. So, I'm share my PPT. Visible?
Visible, sir. Yes.
Thank you. So, good evening, friends. Once again, today our topic is compliances of factory under new labor code. Actually, in previous session, that is 85th webinar, we have broadly taken the compliances under all 4 new labor code. Okay, so going forward, today we will discuss what are the compliances under Factories Act which are replaced for in new labor code, and what other compliances a factory need to comply, what other 3 codes will impact the factory. So we'll start from this. Actually, we all know that on 21st of November 2025, all 4 new labor code has been implemented by the central government, and of course these 4 codes are implemented by repealing or by merging 29 existing central labor laws. Okay, all these merged or repealed acts are central, not state acts. Okay, so these labor codes are the Code on Wages 2019, Industrial Relation Code 2020, Code on Social Security 2020, and Operational Safety, Health and OSH Code, in short, 2020. Okay, so a factory earlier covered under Factories Act. Okay, and that act is merged in OSH Code, OSH Code 2020. Okay, so broadly we will discuss the OSH code, and obviously only for factory compliances, and of course what other three code will impact on a factory and how the factory will deal or how the employer will deal on new provisions under these new labor codes. Okay, so first of all, we will see why the change is required. Actually, all we know that our existing law were dating back to 1930 to 1950, 1948, 1936, 1948. So there was a requirement of updation of the law. Actually, if we will discuss the Bonus Act. Okay, so there previously the limit of Bonus Act was rupees 100, rupees 50, rupees 150. So in 21st century, these law need to be implemented. So our all the dating back the law were repealed due to their old provisions. Second reason is complex overlapping regulation. Of course, there was many document under different law. In Bonus Act, we have to file returns under Bonus Act. We have to file returns under Minimum Wages Act. We have to file returns under Shop and Establishment Act. We have to file returns under EPF, ESIC, and other Payment of Wages Act. So there were a complex regulation or complex filing system under existing law. Compliance burden and uncertainty and outdated for modern economy. Of course, these existing law were outdated due to many things, such as their limits, their provisions, their return filing status, their even for their penal provisions. If we talk about penal charges, so there were very low or a little penal charges under earlier acts, and the new act streamline compliances process aligned with global standard. Of course, these new four codes were framed by the government as per the requirement or as per the direction of WTO. Okay, so these all four new codes are globally standardized, and of course, globally accepted provisions were mentioned in these four codes. And government tried to make compatible with globally accepted or globally prevailing existing laws. Next region for new codes is recognition of gig and platform workers. Of course, there were earlier there was a huge problem. We can say that the gig workers or platform workers were not recognized, not properly paid, not no social security were provided to gig workers. So the new code recognize these persons, and of course provide a very proper social security, other facilities, and of course payment of wages on time, bonus provisions, overtime provisions, etc. Next is fixed term employment provision. A new term which is fixed term employee were added in our new codes that will impact on contractors, contract labor, and of course employers to provide them a proper social security, proper benefits, and of course it will also benefit to employers also. Just because if earlier if an employer was hired, let's suppose hired a contract person or contract labor, then there was no legal provisions or legal liability for a contractor. Now the fixed term employee is recognized by law, and of course the legal terminology identified, and of course legal liability were also imposed on employee as well as employer. So these are the reasons that why the new labor code has implemented and modified. So now we will discuss key area for a factory under OSH code, that is Occupational Safety, Health and Working Condition Code. First is the provision under new code is for unified registration. Actually, the government government implemented the new codes. It's not about only OSH code, but it's for all codes. Government implemented and provided that a single registration will be sufficient for all these new 4 codes. Okay, so earlier, if I talk about earlier system, employer need to take PF registration, ESIC registration, he need to take labor license such as contract labor, migrant worker, shop and establishment act, and many other factory license, pollution certificate. So under these new codes, government implemented and assured that it will be very soon, government will launch very soon a unified portal on which all these compliances will be done unifiedly or at a single place. That is, a single registration will be required for all codes, and government has also assured that only a single return will be required for all these compliances such as PF, ESIC, factories, etc. So this is the major change, or of course it will very beneficial for employers, such as for employer will reduce their compliances cost and of course manpower, etc. Second provision is for mandatory documentation. Actually, the new labor codes has also mandated that every employee will be provided a written appointment letter or written document for their job or service, we can say. Actually, the logic behind this, that if we, for example, if I talk about a daily wage type person, okay, so if a daily wage earn, let's suppose 10,000 per month in a factory, so if he didn't have any appointment letter or any document, he cannot say to anyone that he is doing a job or he is earning money. Okay, next reason that if he need, let's suppose he needs some amount of loan, let's suppose even 50,000. Okay, so bank will ask that there, what is the proof that you are doing job. Okay, so appointment letter is necessary, and we can say pay slip, appointment letter, etc., offer letter. So the government sorry the purpose of the government is that every employee has right, that every employee has right to have appointment letter, so he can show to the place where he needs, or he can assure himself also that he has appointment letter. Okay, and if we, again, if I talk, if there is any let's suppose dispute between employer and employee, so how he will prove that he is doing job there. Okay, let's suppose in court, in litigation, he has to show their appointment letter or any document, written document, which prove that he is the employee of that organization or employee of that employer. So that's why mandatory appointment letter is made by the government under these new 4 labor codes. Next is working hour cap. Actually, government also modified the working hours management. Earlier, if I talk about earlier law, there were maximum 9-hour working were allowed. Okay, uh, an employee can work up to 9 hours with paid 10 and half, and for maximum 48 hour in a week. Now the government relax to employee and of course employer that a person is allowed to work up to 12 hours per day, provided maximum hours will be 48 only. That earlier limit will be the same for weekly hours. Okay, so if an employee works for 12 hours per day, so the employer mandatorily need to provide 3 week off to him. Otherwise, it will violate the provision of working hour. So maximum working hour are fixed, that is 48 hour, but a person can work for 12 hour per day. So he will get 3 week off in a week. And of course, overtime limits are flexible with state governments. Generally, 50 hours allowed in a quarter. For 3 months period, maximum 50-hour overtime is allowed. But state government can change the overtime as per their requirement. For example, Haryana government has increased the 50-hour limit by 156 hours. Okay, and another state government, I'm not memorizing right now, and another state government has also increased in south states. So working hour will be fixed 48 hour per week, but maximum per day 12 working hour will be allowed now. Next provision is for health monitoring. The employees are also allowed, and this is the new provision under new labor codes, that employees will be allowed for annual health checkup. At least one health checkup will be provided by employer for all the employees having age 40 and above. Okay, so if any employee he is 40 and plus 40 and above, so every employee will get an annual free health checkup, at least once in year. And government has also strict the employer that employer cannot deduct or cannot recover any amount of health checkup from employees in any way. Okay, so it will be the only cost of employer, not beneficial for employer. But yes, of course, employee will get better health condition, and it will not impact not impact more on employers, just because it is the annual provision that once in a year he has to provide annual health checkup. This will be applicable for all the employees having age 40 and more. Another health provision is that if the industry is hazardous, which will be notified by the government later, not yet notified. Actually, government will notify that these industries will be categorized as hazardous, and the percent of or in other parameters, that how hazardous the industry is. So in hazardous industries, the provision is that employer is liable for health checkup along with medical facilities to all the employees, irrespective of age group. The earlier provision is for only for 40 plus year employees, and in hazardous industry the provision is for all the employees. Okay, so all employees in hazardous industry will get the benefit of health checkup and of course medical facilities. The interval of medical facilities and health checkup in hazardous industry will also be decided by central government through notification or through circular. Next provision is for enhanced safety standards. In occupational safety, health and working condition code, the government mainly focused on medically medical conditions, employees' health conditions, environment, working environment condition, workplace safety, etc. So the government announced that employer will provide all the environmental facility, working condition facility, such as proper fencing, crèches facility for children of female employees, maternity benefits, proper canteen facility, proper toiletry, urinary facility, clean water, uh, everything proper, dresses, vagara, etc. So all the safety standard will be covered under occupational safety, health and working condition code, and an employer, of course, will have to comply with all these provisions. Actually, the safety standards will depend on industry to industry. That is how industry is hazardous, or what are the standards will be applicable for a particular industry. Next key area for a factory is that migrant worker protection. Actually, there are possibility that in at a place migrant workers are also worked. Migrant worker means interstate migrant worker, which means that a person of a state works in another state. For example, uh, like in Bhiwadi Alwar side, so there are many labor works of Bihar, UP, and of course Delhi, Haryana. So in for interstate migrant worker, the government also announced that journey allowances will be provided to all the interstate migrant workers. Journey allowances means from the place to from their hometown to working place, and working place to hometown. Not frequently, but we know that if the worker is going daily, or the location is nearby, let's suppose 10 kilometer, 15 kilometer, then he will be entitled for journey allowances. Also, government has also provided provisions of grievance helpline for interstate migrant worker. The government will very soon launch a helpline for all the migrant workers, or of course contract workers also. So these workers can take help, or can submit their queries, complaints to the government officials or to the labor departments. So these are the some key compliances area for factory under operational occupational safety, health and working condition code. Now we will see other code compliances also. Actually, the code uh, for a factory, we all know that all these four code will be applicable. Okay, so a factory will also comply for code on wages. Factory will also comply for social security code. Factory will also comply for industrial relation. To that extent, it applicable. Wage compliances, for a factory, uniform wage need to be payable for all these employees which are working in a same level or same type of work. And wages are also changed under the code on wages. Actually, earlier there was no limit for basic salary, or we can say wage. Now, under new labor code, the government uh, has clarified that minimum 50% basic salary should be at least 50% of total remuneration. Okay, actually, wage has a definition which has two part. The first is inclusion part and second is exclusion part. The first part, uh, that is inclusion part have three elements. Wages includes basic salary and dearness allowances, DA and retaining allowance. And the exclusion part includes HRA, other allowances, gratuity, other retirement benefits, other perquisites, etc., provided by employer. So the definition says that proviso say that if the exclusion part is more than 50%, then the remaining excess of 50% will be added back to inclusion part. So automatically the basic will be at least 50%. We are generally if we talk about private organization, they generally do not have DA or retaining allowance. So we will discuss only basic part, or in most of the organization only there are only basic salary, there are no DA or no retaining allowances. Retaining allowance means any allowances which are payable to retain the employee without work, such as COVID situation. In COVID situation, employers paid salary to employees, but there was no work. So this will not, of course, a regular occurrence term. So we will discuss only. We will discuss that basic salary should be at least 50%. There are also provision of minimum wages under new labor code. Actually, the minimum wage, the provisions of minimum wages are regularized by state governments. Okay, under new codes also the provision will be or regulated by state government only. The government will announce, state government will announce the minimum wages as per their state requirement or as per their industry. But the government has announced the national minimum wages, we can say. The term is national floor wages. So every state government shall comply with the national floor wages, and state government cannot fix the minimum wages below that level. That means national floor wages. So it will also help to employees that at least minimum security will be provided under these new labor codes, that central government generally central government not yet fixed or not yet notified the national floor wages, but he will very soon notify it. And of course the minimum wages, national minimum wages or national floor wages will be fixed by considering existing minimum wages of all the states. The government, central government will fix the national floor wages by considering existing minimum wages of all these states. Currently, what are the amount of minimum wages in every state? The next provision is timely payment. Of course, code on wages also provide timely payment of wages for daily wages. For daily payment, code mandate that employee has to be paid at the end of the day, and for weekly payment, employee need to pay at the end of that week. Okay, and that should be working day. For example, if employer is paying for Monday to Saturday, so employer need to pay on Saturday only, not on Sunday. And for if the employer is paying for Monday to Friday, then he has to pay on Friday only. That means that the payment day should be working day. And for if the employer is paying for 15th for a fortnightly, okay, for 15 days, so he has to pay within 2 days from the end of that period. And for monthly payment, maximum on or before 7th. Okay, so employer need to pay on or before 7th of the month, next month. Okay, if the on 7th there was holiday, so employer need to pay on 6th only. he cannot go beyond to 7th of following month. So a factory also need to comply all the ways compliances under code on wages. Further, a factory should also comply with equal remuneration provisions which are provided under code on wages. All the employees will be paid equally for equal work, and of course male and female staff will also get equal salary for equal work. The employer cannot discriminate uh, through gender discrimination is also not allowed. Now, industrial relation code. What are the provisions under industrial relation code for a factory? And the first is fixed term employees. Government has announced the new term fixed term employment. Actually, fixed term employment means an employee working for a particular period, and that particular period should be written in appointment letter. Okay, and that should be certain. For example, an employee is hired for a period of 1st of Jan to 31st March 2026, 27, whatever. And or an employee was hired for a period of 11 months starting for 1st of April 2026. So that employee will be considered as fixed term employee. Okay, for fixed term employee, the government announced under industrial relation code as well as social security code that all the benefit will be provided to fixed term employees which are provided by employer to their permanent employees. So fixed term employees will get of all the benefit of permanent employees, and of course they will also get some additional benefits such as gratuity. Okay, for gratuity for permanent employees there is a existing limit which will continue that for 5 years an employee need to continue service of 5 years. But for fixed term employee, the government announced that fixed term employee will be eligible for gratuity even if he has completed 1 year of continuous service. So fixed term employee will now get gratuity even after 1 year continuous service. Next provision under industrial relation code is that trade union recognition. Of course, 51% employees will be required for trade union recognition. There are other provisions of under industrial relation code, which is standing order applicability. Actually, industrial provisions under industrial relation code are more beneficial for employers. Okay, earlier standing order applicability was on an organization having 100 and more employees, but now the government changed the applicability and by 300. Okay, so now standing order will be applicable on an organization having 300 plus employee. So let's suppose an organization have 200 employees. Earlier he need to take approvals for all these actions such as layoff retrenchment, closure of business for concerned authority. Now the organization need not to take any approvals from the concerned authority just because standing order is not applicable as employee size is less. Another provision under Industrial Relation Code is that if an employee hmm, if an employee engage in strike etc without notice or without intimation to employer, then employer has legally right to deduct 8 days salary of him for a 1 day strike. Okay, so एक दिन के बदले 8 दिन की सैलरी एम्प्लॉयर डिडक्ट कर सकता है if the employee found without approval or without intimation in engage in strike etc. So this is also employer friendly provision. So these are the main provisions under Industrial Relation Code for a factory. Under Social Security Code, of course, mandatory PF and ESIC compliances, ensuring financial security. Government is also considering the limit of existing PF and ESIC. The 2 or 3 days ago, the Supreme Court has also directed government to reconsider the limit of 15,000 that was earlier increased in 2014. Actually, before 2014, the limit was 6,500, and in 2014, EPFO limit was set as 15,000, and it's been approx 11 year lapse, but the limit was same. Okay, so the court also directed the government to reconsider the fact that the limit should be changed. Okay, universal coverage. Of course, the Social Security provision code also mandate that all the employees, whether they are permanent, whether they are contractual, whether they are fixed term employees, whether they are daily wagers, whether they are gig workers, and even the code also mandate employer that even an employee worked for a single hour, he has to deduct PF, ESI, or he is eligible for Social Security for that 1 hour working. Maternity and gratuity benefits, of course, mandatory provisions of 26 week of maternity benefit is also made strict under Social Security Code. So if any female employees are working in a factory, so they will get 26 week of maternity benefit. Next is portability provisions. Benefit transferable for migrant and contract workers. Of course, migrant and contract worker were also recognized under these new labor codes. These worker will also get equal benefits. Okay, now contract worker will also get equal benefits which are provided to permanent staff. Even if employer cannot discriminate by any facility provided to between permanent and contractual staff. So now employers will need to provide all the benefit to all the workers equally. transitional challenges and compliance strategy. What will be the compliance strategy? Of course, current state, yeah, the four codes were effectively immediately effective made immediately effective by the government, that is on 21st of November, but the rules or other things such as circular or clarification were not made by the government. So on 30th December 2025, the government released draft rule for all four codes and provided 30-day for industrial relation code and for 45 days for all other three codes to submit representation or to submit any issue or problems, or if you want to provide any suggestion to government. After that, the government will finalize these rules and will implement most probably in the month of March or maybe in the month of April. So a factory need to update documentation as per their new labor code, new labor provisions which are provided under new labor codes. Of course, digital transformation, implement digital record keeping system, complete single return registration process. Single registration process is not yet started by the government. Government will soon launch a portal, unified portal, on which single return or single registration facility will be provided. Training program, of course, HR team and account team and backend team need to be trained as per new labor code. And active monitoring. The government made strict compliances under new four labor codes. So, if earlier, if let's suppose if employer is not following or not complying any provisions, then that way was not make any huge impact. But now, if employer will not provide or not comply as per these new labor codes, so it will be more penalty under new labor codes, and there are of course some criminal provisions also. So all the factories or of course all the employers need to comply with all these new labor codes with very active monitoring. There are penalties were also increased. Earlier there was small penalty, but under new labor codes, penal provisions were also made strict, or compliances were also made rigid. Compounding of offense allowed under new labor code. Of course, there were earlier system of inspector, that inspector will come to our place and he will issue notice, or he will assess, or he will issue demand order. Now the inspector gave some rights as well as some duties also. So they will also provide corrective action for any non-compliances. Okay, so he will suggest that how it will be corrected, and going forward you have to take proper care of these provisions. Of course, joint liability in business transfer. If let's suppose you are director in a company, okay, and you resign on a particular date, and later on the notice under labor department or through PF office, gratuity office, or ESI office came, so you are also liable jointly, even you are not right now the part of the organization, but if organization has made any non-compliance for the period for which you were director. So you will also be jointly liable. Non-compliances risk, significant financial penalty. Of course, we have already discussed that penalties were increased in new labor code, so it will affect the financial position or financial uh, of an organization, reputational damage, operational disturbance, and legal proceedings and delay. So these are the known compliances risk if you are not complying with new labor codes or other provisions. Preparing factory for a future ready workforce. Course, transformational shift, new labor code. You need to follow the provisions under all the new labor codes. Prioritize workers' welfare and adopt digital compliance to national alignment with standards for wages such as national floor wages, safety, security, social security. So these are the pointers an employer need to follow immediately. Thank you. Yes, Sarvanji.
Thank you, sir. Thank you, Chetan Agarwal ji, sir. I would like to share that the total number of participants in this seminar is 245. It's very good. I also request all members for register for WAFA, WOFA of ICI at earliest. The schedule for the WAFA is from 30th January to 1st February 2026. So please register yours at earliest. Thank you, sir. Thank you, Chaitanya Agarwal, sir. Question answer. Mr. Deepak Mehta of Jaipur asked whether overtime provision is applicable to worker or employee. Second question is how many paid leave are allowed and now how many can be carried forward?
So paid leaves are allowed as per Shop and Establishment Acts, which are not aligned under new labor codes. Actually, Shop and Establishment is a state level act. So this compliance will be done as per Shop and Establishment Act. Okay, and states have their separate provisions for leaves. So if you ask for a particular state, I will definitely answer.
Jaipur, he is actually from Jaipur. He is asking from Rajasthan actually.
Okay, so here I think
From Jaipur, Rajasthan.
yeah, for Rajasthan
From, yeah.
there are approximately 30 leaves allowed
30, how
under
many
Shop
paid
and
leaves are
Establishment.
allowed? 30s.
Yeah,
How many leave can be carried forward?
there are no provision for carry forward actually.
Okay.
So these are the policies under these depends under company's policy. Okay,
That's a
also
company's policy.
in Rajasthan
No
there are
guidelines, no guidelines provided actually.
yeah, in Rajasthan there are also no bifurcation for paid leave, sick leave, etc. There were
Whether overtime provision is applicable to worker or employee.
so in earlier law, the overtime provision were applicable to workers, but as per new labor code, the overtime will be made applicable to all these employees. Now the rules are pending, so we have to wait for a clear position that, for a month or two. After that, it will be clear, definitely from a government perspective, right? But as if I am talk about the current situation, so as per new labor code only, the overtime provisions are applicable for employees also.
Thank you, sir. Thank you for sharing your valuable knowledge on the topic. It's very important topic, compliance of factory under new labor code. Thank you. It will be very helpful for us a lot. Now actually, chairman and vice chairman is not available. Now we have to conclude the session actually. I would like to conclude the webinar and sincere thank you all the participants who participate the seminar. Thanks thank you Chetan Agarwal sir, thank Akshat Maheswari sir, and all the team and the CP committee. Thank you sir. I would like to conclude the seminar saying thanks the chairman Sri and by C.S. Satish Kumar Gupta sir and vice chairman Sri Vishnu Kumar Agarwal ji for providing me as a to be part of as a moderator and speaker C.A. Akshat Maheswari ji and C.A. Chetan Agarwal ji for sharing your valuable time and good topic. We are grateful for the insightful deliberation and practical guidance shared during the session. I also thanks all the participants for their active participation and valuable presence. We look forward to your continued support and participation in near future CP program. Thank you, sir. Thank you, sir. Thank you so much.
Thank you so much. Thank you so much, sir. Thank you.
Thank you, sir. Thank you.
Thank you so much. Thank you.
CP committee would like to thank both our faculties and Shravan sir for this amazing session.
Thank you, sir. Thank you.
Thank you.
Thank you.
Bhagaji, we can end it here. Yeah.
disconnect कर दे, sir.